Better System Trader, episode 51.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi, this is Andrew Swanscott here, and welcome to episode 51 of the Better System Trader podcast. Thanks for joining us. Today we're covering a topic which can really be a concern for traders of all levels, from beginner to pro, and that is the topic of strategy evaluation. Have you ever found that real-life performance does not match expected results? Or perhaps you have a strategy that is stuck in a drawdown and you're wondering if it's actually broken? Now, I'm sure we've all heard of data mining bias, over-optimization, curve fitting, and the impacts this can have on our trading accounts. We may even be using techniques such as out-of-sample testing, Walkforward analysis, Monte Carlo analysis, and a number of other measures to identify or reduce the impact of these issues. But do these approaches actually work? Are there limitations or dangers with these techniques that we need to be aware of? Or are there better ways? In this episode, we talk to someone who evaluates trading systems for a living, plus his research into system evaluation techniques has won awards. That guest is Dave Walton. Dave was the winner of the Wagner Award in 2014 for a paper titled Know Your System, Turning Data Mining Bias to Benefit Through System Parameter Permutation. In our chat today, we talk about the technique in his paper and how it can be applied to trading strategy evaluation. We also discuss some of the assumptions and limitations of that approach, and he shares with us some really valuable insights he's made since publishing the paper, which have resulted in an updated approach he now considers a better alternative. So make sure you listen out for that. Now, before we get started, a quick word from our sponsor. How would you like to copy the trading of some of the best traders around, automatically taking the same trades they take in their own personal accounts? Traders like Michael Cook, Larry Williams, John Ehlers, or even Linda Raschke? Well, you can with worldcupadvisor.com. For more information, check the show notes page at bettersystemtrader.com/51. Trading futures and forex involves significant risk of loss and is not suitable for everyone. And now on to the chat with Dave. Hope you enjoy it. Hi Dave, welcome to the show. It's great to have you here today.
Oh, thank you very much, Andrew. It's great to be here.
So how about we start with a little bit of background on yourself?
Sure. I'll start from the very beginning.
Sure.
I have degrees in computer engineering and computer science, and I spent almost 20 years using those degrees in high tech in Silicon Valley. A lot of my engineering work was focused around validation of hardware and software. And I also had an interest in finance and trading. So I ended up getting my MBA in finance, about 12, 13 years ago. I thought I might learn something about trading there. As it turns out, I didn't. So I also have completed Dr. Van Tharp's Super Trader program, if you're familiar with that,
Yep.
to actually learn more about the nuts and bolts of trading. You know, I was somewhat of an odd man out in that program because he's focused a lot more, if you're familiar with his work, on psychology, which affects us all as traders. But when it comes to the actual trading approaches that most of his students use, it's more discretionary, or a lot more discretionary than where I'm focused. Now, with that said, there was a lot of good concepts, and the psychology, of course, was very key to success. But I just wanted to make it clear that I was much more on the quantitative side of things than the typical super trader.
Yeah.
And when I finished up the Super Trader program, obviously I've been a private trader of my own funds. I've also been involved with some RIAs, helping them with some of their systems, and then kind of parlayed that based on what I had learned and my experience in the high tech industry, especially in the validation, on applying some quantitative methods to validating trading systems. And that actually led to me writing a paper that I submitted for the Wagner Award competition in 2014, and actually won that. And I think we're going to talk more about that later.
You sure are.
So, and then around that time frame, also started a company to help RIAs and hedge funds and family offices and those types of more sophisticated investors to validate their quantitative or systematic trading approaches.
Okay, great. Well, thanks for sharing your background with us there, Dave. That's interesting to know. So, I guess the reason why this chat came about was I was at a trading workshop in April this year, and system parameter permutation came up in conversation. As you mentioned, you submitted a paper to for the Wagner Award. The title of the paper is, let me get it, Know Your System, Turning Data Mining Bias to Benefit Through System Parameter Permutation. Now, as you mentioned, that paper won the award back in 2014. I think it created a little bit of debate at the time as well, so I thought it might be a good opportunity to discuss the concept with you today and see if you've had any fresh insights since then. But firstly, can you explain what is the Wagner Award and who's it for? Who typically submits papers for review?
Yeah, so the Wagner Award is put on by an organization called NAME, the National Association of Active Investment Managers, U.S. based. And I think it's been going on for 7, 8 years. I'm not exactly sure. But these are all active managers. And they started the paper competition to get much more data and visibility to active management approaches, because everyone's probably familiar with the passive versus active argument. They're obviously much more focused on the active side, and they wanted to foster additional research and data through their paper competition. And I think they have submissions from academics, practitioners, some private traders as well. I think they have a good mix. I think the folks who usually win are either consultants or academics or practitioners.
Yeah. Okay. So why did you actually enter a paper into that?
I wanted to bring more visibility to the whole concept of trading system validation and zero in on a big issue with developing any kind of quantitative trading system, which is called data mining bias.
Yeah.
And I wanted to provide a somewhat easy method to help mitigate that.
Okay, so as you mentioned, you do discuss data mining bias in that paper. So perhaps the best way to understand it would be, could you run us through a generalized example of the process that system developers often follow when creating trading systems and how that can introduce data mining bias through that process?
Sure. So let me start off by saying it's pretty well established that the market price action is influenced by noise, and depending on how much how much you subscribe to the efficient market hypothesis, which I think most active traders don't subscribe to it that deeply, but it's either 100% noise, which is effectively what the efficient market hypothesis says, or there's some signal, but then there's a lot of noise overlaid on that signal. And I want to mention that up front because it's key into understanding data mining bias. So the typical approach that many systematic developers follow is they'll have an idea on something that they think gives an edge, and depending on how computer savvy they are, I guess. They'll either automate the whole process or go through some of the manual steps, but in the end result, it's really the same, where they'll look at what's worked in the past using historical data. That can be something that can either be looking at charts or having a computer run optimizations for you, and find what's worked best in the past. And the problem with that is, in that optimization, the developer is not only optimized on any signal if it's present, but also the noise that existed in the historical data. And what data mining bias basically is expecting that same level of performance to continue in the future when you've optimized on that noise, and noise by definition is non-repeatable. So the end result is typically trading systems fail miserably to meet that expectation of matching historical returns in backtesting.
So what factors can actually contribute to data mining bias?
Well, it's there's a very good book written by David Aronson. The title is something along the lines of Evidence-Based Technical Analysis. I don't know if you're familiar with that.
Yep, that's the one.
Yeah, so he actually goes into great detail on all of the factors, because there are multiple factors that influence that. I think probably the biggest factor in my mind is the number of combinations of things that people try, either with complete knowledge of what they're doing or unwittingly. They look at a bunch of different, say, indicators and parameters associated with the indicators to try to effectively fit the historic data. And like I said, when you do that, you're fitting noise as well, and that typically ends in disappointment.
Yeah, okay. So is there any way to measure or data mining bias, or perhaps some early warning signs that you're engaging in that kind of a process?
Well, yeah, and that's effectively why I wrote the paper on system parameter permutation. The more iterations you run, the higher the data mining bias is going to be responsible for the results you think you're getting, is one. So that's a big one. If you're running billions of combinations of things, it's a strong likelihood that the performance that you think you had in the past is probably very much due to noise. Now, the other thing is, depending on how many rules are applied, meaning some people call it degrees of freedom, although it's not exactly degrees of freedom from a statistical standpoint, but how many functions you use to effectively fit the data as well influences it. So if you have a very simple system, less likelihood in general that data mining bias is going to be a large problem than on the flip side, if you have 100 different cases that handle specific scenarios from historical data, then it's a very high likelihood that data mining bias is going to be responsible for your results.
Yeah, okay. So I guess there are a number of other approaches to validating trading systems. For example, Monte Carlo analysis, out of sample, Walkforward. So do they address these problems of data mining bias that we're talking about?
Well, let's start with out of sample testing.
Yep.
Now, and this is really the gold standard, I think. It's very quick and easy to do in theory. And I'll come back to the why I say in theory. And it does, if it's done properly, does give you an unbiased estimate. So your out of sample performance is not subject to data mining bias because it's held aside. But there are limitations to the approach. The main thing is when you do out of sample testing, unless you're talking about your out of sample being you're going to trade the system live and gather that data over time. But most people, they set aside some section of data and they hold that as their out of sample, and somehow they determine where they're going to split that data. And if, from what I've seen, for the most part, it tends to be somewhat arbitrary on where that data split happens. But that data split is where you decide to split the data is actually critically important to the outcome. You can imagine if you have years and years of a bull market and your system is something that you've designed to work well in bull markets, and then all of a sudden right where you drew the line or close to it, as far as your out of sample data, then it shifts to a bear market. You can imagine that your out of sample performance is not going to be representative of what you might expect had the market conditions stayed the same. So that split can be very misleading. In that particular case, it would probably cause someone to reject a system, and it may be perfectly good. But there's also the converse where it's all of the data is, say, a bull market, and you do a split in the bull market and everything looks good out of sample, and you expect that to continue, right? And then of course, most people also make the out of sample period somewhat smaller than the in sample as well. So you have much less data to draw a conclusion on. But I would say the worst thing about out of sample testing is a psychological problem, meaning it's almost impossible for someone not to cheat. And what I mean by that is, and this goes back to my comment about coming back to if it's done properly, you're developing a trading system, and you do your diligence and you actually hold the out of sample data aside, and you don't cheat, you don't have data snooping into that. You like what you see from your in sample. So, and then you run it on the out of sample, and you do not at all like what you see as far as performance. So then you have a choice at that point. Do you give up and say, okay, I'm going to do something else, not, and i.e. not doing a trading system, or do you start over? And if you start over and you're using the same data, well, effectively what you've done is made that out of sample data in sample. Yeah. And the more you do that, obviously, the bigger the problem you have.
Yeah, okay. We'll just jump back a little bit for a second. So on the splitting of the in-sample and out-of-sample data, I know some traders who actually choose some in-sample data for different types of market conditions. So, for instance, they'll take a slice of a bull market, a bear market, a sideways, and also different kind of volatility regimes, and they'll stitch that data together. That'll be the in-sample, and the rest will be out-of-sample. What do you think about that type of approach?
I think that's a much better way to do it. It would be much more representative, assuming the out of sample has similar market conditions that stitch together. Yeah. That's a much better way to do it. But the outcome is still, a single. It's a binary decision based on what you happen to see on that out of sample. That is just a function of the in sample out of sample approach.
All right. So what about Monte Carlo?
Yeah, Monte Carlo. Obviously that's a good segue from my last statement. So if out of sample is a single outcome, well, Monte Carlo attempts to solve that problem. Of course, should I explain Monte Carlo, or will most of your listeners already know what it is?
I think everybody knows, but I don't know. Can you explain it in 30 seconds?
Yeah, sure. So effectively, this is how I look at Monte Carlo. Effectively, what it does is it you have the historical performance of a trading system. It can be either back tested or traded live. Obviously, it means something. It means more if it's actually live trades, but because of the data mining bias I mentioned before. But let's assume it's back testing. So you have a simulated equity curve or set of trades that you get from your back tester, and there's basically two ways that Monte Carlo is typically applied. One is the individual trade results are kind of reshuffled. That's a very common method. Or another approach is the actual, bar by bar returns can be reshuffled as well. And the Monte Carlo approach, of course, randomizes which bars or trade samples you're choosing and stitches together another set of trades or another equity curve, and you do that many thousands of times, and what you end up with is a distribution. So instead of having one path, you have in theory thousands of paths to draw conclusions from. So, and that's great. Definitely advocate using a range of performance or distribution for drawing conclusions from a trading system. But the big problem that I see with Monte Carlo techniques applied to trading is, first of all, where that initial set of trades or equity curve is coming from. If it's coming from an optimized backtest, well, then effectively what is done is you have an overfit input that becomes an overfit an overfit output. And in the computer industry, we have a saying for that. It's called garbage in, garbage out. So that Monte Carlo cannot save you from that. The other thing is there's some assumptions that are made when applying Monte Carlo, which in a lot of cases are not valid, depending on the trading system that you're using. So specifically, what I mean is one of the assumptions of applying a Monte Carlo approach is that trades or the returns from the equity curve, depending on which approach you're using, are independent and identically distributed, meaning that any of those individual trades or returns could happen at any time. And we know from a lot of analysis of capital markets that that is actually not a safe assumption, that there's a lot of clustering of volatility in similar types of trades around different points in time. And we don't see an equal distribution across time, which Monte Carlo assumes. The other problem is if you have any kind of trading system that uses multiple instruments or symbols, it gets very complicated, first of all, but the net of it is that portfolio effects are effectively ignored in applying the approach, meaning it's not a simulation, a complete historical simulation. It's a simplification, meaning it assumes that any trades could happen together at the same time and produce a return. It could, depending on the algorithm, it could actually pick the same trade twice and assume that trade happened with itself at the same time, as an example. And it also assumes that you have the buying power to take those trades at the given time, which in a lot of cases is not a good assumption either.
Okay, and what about the third one that I mentioned there, walk-forward analysis?
Yeah, so Walkforward is effectively a more sophisticated Insample, outofsample approach. It's primarily targeting trading systems where parameters are re-optimized over some duration. So I'm going to assume that your listeners know how it works, but instead of doing the in-sample, out-of-sample once, you're effectively doing it multiple times and walking that forward. So it suffers from a lot of the same things that in-sample, out-of-sample suffers from. Especially even more so the problem of cheating, because that out-of-sample data is used right away in that case.
Okay, well that leads us nicely into system parameter permutation, because we've obviously just covered some of the existing approaches. So can you explain what that is?
Yeah, so if you don't mind, I would just say that the system parameter permutation is a simplification of a more general approach, which if we have time, I'd like to talk about too.
Sure.
Called stochastic modeling, which is used in an actuarial setting. Insurance companies use it to price to make sure they don't go bankrupt when they write policies or create financial instruments. But going back to SPP, which is my shorthand for system parameter permutation, you have, when you're developing a trading system, you're going to have rules, as we've already talked about, and then you're going to have some, if you have the type of system that uses parameters for those rules, then you're going to have a range of parameters. And like we talked about in the beginning, a very common approach is to do optimization across those parameters using the rules that you've identified. And then, of course, the optimization engine picks the best. And that is subject to data mining bias, as we said before. So in a very simplistic explanation, system parameter permutation says, well, don't just pick the best, the extreme outcome, the extreme positive outcome. Look at the distribution of the results that you're seeing. And if you have to pick a single choice, then look at the median of the results that have come from your optimization.
Yep. Okay. So what benefits do you achieve by using that approach, looking at all the optimization runs?
Well, effectively what it does is it dials down your expectations on what to expect from the trading system. So remember, the optimized equity curve is subject to data mining bias. So the performance that you can expect from your system is at least overstated, and hopefully it's not zero or negative. So what system parameter permutation will tell you is, over this broad class of systems, what general performance characteristics can you expect? And that's what you get from looking at the distribution and the median versus just the top performer.
Yeah. Okay. So it sounds like it gives us some additional information or benefits over the usual approaches. Can you explain that a little bit more?
Yeah, so the first benefit, which is also a benefit of Monte Carlo, is you have a distribution of results that you can draw conclusions from, rather than just a single path. And unlike Monte Carlo, which I explained suffers from some assumptions and can also suffer from overfit input leading to overfit output. What system parameter permutation does is it gives you somewhat of an unbiased distribution. And because each of those pass through historical data, were run through a backtesting engine or historical simulator, there's no assumptions made on the trade and returns, what the distribution of trades and returns is, meaning there's no assumption of being independent or identically distributed, and portfolio effects are taken into account because it's actually simulated.
If we can just dig a little bit deeper into the application of the SPP approach, let's start with one that seems to have caused a bit of a stir at the time, and that was the selection of the parameter range for the optimization runs. So I realize that was out of the scope of the paper, but I guess it's a key point in determining the results of the process, because obviously the selection of the parameter range and the incremental observation points is key in determining the median. So I guess the sampling boundaries can easily be skewed by our own selection. So what are your thoughts on boundary and increment selection there?
Yeah, that's actually, I'm glad you brought that up. So yes, that is the assumption or input into the process. You hit the nail on the head. So what I find is that if you start with you have to look at what you're trying to achieve with your trading system, meaning if you're say developing a trend following trading system, you have some expectation on the what kind of trend you're going to target, and given that expectation, you can then be somewhat intelligent about the parameters from which you select. So if you're using, say, a moving average, Yeah, you want to pick a range of moving averages that make sense for the length of the trend you're trying to pick. But that there is no formula for setting that. I'll be the first to admit. So it's somewhat art as well as a science that's applied. So I don't know if that answers the questions or if you want to dig deeper.
But I guess doesn't the act of choosing the parameter range yourself also introduce data mining bias? I mean, it could either be directly based on past experience or past testing that you've done, or even perhaps you try an initial range that didn't perform as expected, and there's that temptation to adjust the parameter settings. So,
Yep.
doesn't that kind of add data mining bias just by choosing the parameter range yourself?
So if you pick a parameter range and you stick to it based on kind of what I said, some intelligent process, then there's much less data mining bias. Yes, you're making a decision, but you're making a decision across a distribution versus what you see from one optimized run, right? So your expectation is your expected performance is much lower than that single optimized run to begin with. And if you do continue to say you don't like the results from SPP, and you continue to play with those ranges, and absolutely you're introducing data mining bias. It's just like reusing your out-of-sample data. It will result in bias, no doubt about it. Now, one thing that can be done though is more of a sensitivity test using the process where you initially you pick some range of parameters that with some intelligence, and then what you can do is some kind of sensitivity, so you can actually widen that range and look at how your performance of the distribution of equity curves that you get as a result perform. So, meaning, for example, if you for the sake of argument, are having this trend following system, and you're using a 200-day moving average as your trend indicator, and you've chosen initially 200 days plus or minus 10%, let's just say, for the range you're going to look at, then you can look at, well, how does it look plus or minus 15? How does it look plus or minus 20? And if you see performance really drops off, then I'd be a bit concerned about that. I'd rather see something that slowly degrades as you increase that parameter range.
Yeah, okay. The comment you made about the intelligent selection of parameters, I think that probably comes with a bit of experience developing systems and seeing market behaviors. But what if, say, for instance, if I'm completely new at this and I want to test something that like trend following, where we know that the concept works, but I just through bad luck I choose a poor range of parameters, or maybe just through good luck I choose the sweet spot. How do you determine then the difference between, this strategy actually does have a known edge, or I was just lucky or unlucky in choosing the parameter set?
Well, that's where I'd go to that sensitivity test I mentioned before.
Okay.
Because if you did get lucky, you just happen to pick this nice range, as you widen it, then your performance is going to degrade pretty quickly.
Okay. All right. Thanks, Dave. So let's go to the median now. So the use of the median. Why does SPP use the median performance as the best estimate of future performance?
I mean, it's a measure of central tendency of the distribution that you get from the SPP process. It's really as simple as that. I personally want all the data that I can get, meaning I want to look at the entire distribution. But I think a lot of people, and it's human nature, want to distill it down to something simple, one number. In this case, I say, okay, use the median, because it is the center point of that distribution of range of performance that you simulated.
So, how would simply selecting the median parameters instead of the best ones necessarily be replicable going forward? I mean, isn't this approach just as flawed, but using less good parameters to start with?
Okay, so actually, this is a key point as well. So when I say the median, I'm not advocating using the median of the range of parameters to trade. Um, when I say median, I'm saying, okay, you've run SPP, you've got a distribution of results. In order to set your expectations for the performance from this class of system, if you want a single number, look at the median performance. And that median performance is likely not the median parameter settings from what the ranges that you've picked. So I want to make that clear up front.
So let me just see if I got that right. So you're saying that the median, you don't actually use the median to trade, but you're just really using it to assess the overall performance of the strategy?
Yeah, because I think of the strategy as the general class of trading system I'm trying to develop, not the the single path through history.
Right. Okay. So how do you actually determine then which parameter set to use from that that range of optimization runs?
Yes, and I did not get into that at all in the paper, which led to some criticism because that's actually hard work. Um, so there are a number of methods to do this, and I will. Is it okay if I point the audience to a reference?
Yeah, sure. Yep.
Okay, so one excellent reference for doing this type of work is from Perry Kaufman. He has a very thick Bible called Trading Systems and Methods. If you've read that,
Yep.
yeah. So he's got several methods in there on how you actually pick what you're going to trade. In general, a lot of approaches revolve around looking for general stability. And as you get into more and more trading rules and parameters associated with that, it becomes n-dimensional, which can get interesting. But looking for stability so that, if over the historical period, performance of, say, one set of parameters and a broad range of its neighbors is somewhat stable, that might be a good area to pick from to choose what you actually trade. And depending on the amount of capital that's being deployed, typically individual traders can't do this, but large firms like RAs or hedge funds can. They can actually trade multiple instantiations of the parameters on the rules. So effectively, they need to spread out their trades anyway because of their size. They have algorithms that split up their trades. So what I'm talking about here is allocating capital among different individual systems within that range that you've chosen for your SPP.
So you haven't done, or have you done any research into comparing the best parameters versus the median in SPP?
You mean the best from the historical optimization?
Yep.
In fact, I have. So I just did a presentation at the MTA symposium last month, and I talked about that specifically. And I think the recording is going to be available soon, so it may become a resource as well. So, one test that I like to do to kind of illustrate the point here is, why do people pick the optimized parameters? Because they think that's going to be the best going forward as they actually trade it, right? That's the underlying assumption that you would have to have by choosing that particular set of rules and parameters. Are you with me so far?
Yep.
Okay, so let's go back to Insample, outofsample, because it illustrates the point. So you have your optimized trading system with your optimized parameters, and you run that outofsample, and you get a performance metric or metrics depending on what you're looking at. Let's say we're looking at compound annual return and drawdown, just for the sake of argument. Well, you can actually do that for the entire space of systems that you've simulated through your optimization, meaning you don't need to look at just the best from the optimization run. You can look at all of them, and you can see the relationship between the in-sample performance and the out-of-sample performance across thousands of iterations, which gives you much more data. And what I've found, unfortunately, I can't show you. Perhaps I can send it to you. One way of doing this is just a simple linear regression. So you regress the out-of-sample returns against the in-sample returns, or drawdown, whichever metric you're interested in, and you look at the relationship. And what I found across a broad variety of trading systems is that you get a huge cluster of dots, and your R-squared tends to be very, very low, meaning there's a virtual non-existent relationship between in-sample and out-of-sample performance. It can be somewhat skewed positively, or it can be somewhat skewed negatively, depending on the trading system. But in general, I found that the R-square is very low in that analysis. So what does that tell you? It tells you that there is something other than the in-sample performance that's driving the out-of-sample outcome. So, if you when you see that, when you see it visually, it becomes very compelling that, if I pick this one dot, which represents the best in-sample performance, but I can see it could very easily be the out-of-sample could be anywhere
Okay.
in this broad bubble.
Well, if that's something you can share, that'd be great. I might be able to put it up on my website if you're willing to share that. So
Absolutely.
might help to explain it a bit more. Okay, thanks, Dave. So now, how about the number of parameters in a training system? How does that impact SPP? Because I guess, if you have too many parameters, and an exhaustive optimization may not be viable.
Mm-hmm.
However, obviously, a small number of parameters may not provide you with a statistical significance. So
Right.
have you done any research on the number of parameters and that effect on SPP approach?
Yeah, that's a very good question too. So I'll make some generalizations, and then I'll get into answer your question specifically. So
Sure.
SPP will not work if you have a very simplistic system. Say you run it on one instrument, and your system runs on one instrument, and you have a single rule for entry and exit. Then obviously you don't have enough data points to draw any conclusions. You don't have enough to draw any probabilistic conclusions, I should say. On the flip side of that, yes, if you pick very broad ranges, which may be because it's throwing something at the wall to see what sticks. It depends on exactly what you're doing, but it is definitely possible that the simulation space is going to be too large to run all the optimizations to be exhaustive. That is absolutely something that especially individual traders would run into, as they won't have the kind of computing power at their disposal to do that. So that's a good segue into some of my subsequent research, which I presented at the MTA. We can come back to that. There's ways around that problem that I'm happy to talk about. So there is a sweet spot where you are able to simulate it, and you have enough variation in your various parameter sets for your rules, which includes your number of instruments. I don't have a mathematical formula for you, but you need something that's going to be able to generate thousands of permutations to really get anything out of it.
Are there any cases, perhaps types or styles of strategies where SPP won't work?
Yeah, it's really geared towards systematic approaches, so it will not work for discretionary. That's probably pretty clear. but it also is not very applicable for machine learning approaches as well. It's really more geared towards I'll say traditional systematic approaches where the trader has hypothesis or hypotheses on where edges may be, and then you can use SPP to help test that.
Okay, what about the traditional approaches that may use adaptive kind of techniques?
Where you do something like Walkforward, you mean?
No, where perhaps maybe the indicator adjusts based on market conditions, that kind of thing.
Oh, that's all fine. That would work with SPP, as long as it doesn't require manual intervention as it's being traded, or you can't quantify that into rules that you could program. If you can, then you can definitely apply it.
Okay. All right. Now, since the intent of SPP is to avoid, or maybe not avoid, but to minimize bias, are there any occasions where bias can actually make its way into the SPP process?
Yeah, absolutely. You already brought up one where you're you choose a small range and you get lucky, and then or you choose a bad range and you get unlucky, and you keep trying and changing the range. That's introducing data mining bias, as we discussed.
Yep.
There's other biases, of course, that can go into your system. So SPP can't solve all of that, meaning if your system is developed with, say, data that has survivorship bias, that will feed through, and you will have a biased expectation based on running SPP. So it doesn't get rid of things like that. If there's anything like programming errors or look ahead bias or something along those lines, of course, that will feed through as well. So there's no escaping garbage in, garbage out here, unfortunately, when it comes to a lot of the problems that people run into, especially when they're first starting out developing systems.
Yeah. Now, can SPP be used to compare different systems?
It can. It can be used, but the more comparison that's made, and then of course you're going to make a selection based on that comparison, I assume. Otherwise, why would you be making that comparison, right?
Yeah.
The more you do that, the more that you're introducing somewhat of a data mining bias, because that's exactly what data mining bias is a compare and selection. It's just at a different level here that we're talking about than through the optimization.
We're going to take a very short break here for a word from our sponsor. Coming up after this, Dave is about to share some valuable insights he's had since publishing his paper back in 2014, and then he'll introduce us to an updated approach he now considers a better alternative to SPP. But first, here's our sponsor. How would you like to copy the trades of a veteran hedge fund trader with 35 years of market experience? WorldCupAdvisor.com lets you do exactly that. With the launch of Linda Raschke's new Stock Index Futures and short-term diversified leader-follower auto trade programs, you can now make the same trades that Linda makes in her own accounts. That's right, Linda has her own money on the line, right along with her subscribers on every trade she makes in her accounts. World Cup Advisor identifies futures and forex trade leaders through rigorous screening, including live trade evaluation in the World Cup Trading Championship competition, and enables subscribers to mirror their trading buy for buy and sell for sell. As a subscriber, if your fill price is not equal to or better than your lead trader's fill price on any trade, that trade is commission-free from your authorized broker. There are more than a dozen futures and forex programs to choose from, and you can view complete actual performance data before subscribing. To learn more, check the show notes page at bettersystemtrader.com/51. Trading futures and forex involves significant risk of loss and is not suitable for everyone. And now back to the chat with Dave. Okay, now you published that paper back in 2014, so it's a couple of years since then. Have your views in that paper changed, or have you perhaps come up with some new insights or realizations since the paper was published?
Yeah. So I have a good friend who's an actuary. He's a fellow of the Society of Actuaries, and He's also now an RIA. And we've had many discussions about trading, as you might imagine. And he's familiar with my work, and he told me, he said, what you do is effectively what actuaries do. You're applying stochastic modeling to trading systems in one particular way. And my research was already going along those lines. SPP is very much a simplification, and I wanted to do that specifically as kind of an introduction. And that's why I submitted the paper, but it's actually a much broader approach than SPP. In fact, I don't even advocate SPP, to be honest. I advocated a similar but different approach, which solves the problem that we were just talking about of, well, what if you have too many combinations and you can't run exhaustively? So the approach that I advocate now, I actually call system parameter randomization. It's very similar, but it's not an exhaustive permutation. It's a Monte Carlo selection engine overlaid on top of SPP, if that makes sense. So you're effectively getting a sample. You're getting a large sample from the SPP distribution, so that you can apply statistical techniques given that large sample as well, just like you would on SPP.
Okay, have you published any research into that randomization approach, or is there anything people can refer to?
So the only thing that I've published thus far is, and I plan on publishing more, is the presentation that I gave at the MTA symposium last month. And I'm actually happy to, if you're interested, provide those slides so people can look at.
Yeah, I think that'd be great.
Okay.
If you don't mind. Yeah, thanks.
Sure.
Okay, sorry, were you finished with that?
Yeah, so I just want to say that that's a very small subset of the concept of stochastic modeling. I think there's a lot more that can be done with stochastic modeling, and we probably don't have time for me to go into an overall level of detail on stochastic modeling in this interview, but I will say that there's very many applications that are interesting, and that's where my current research is. And we can talk a little bit about that if you'd like.
Yeah, sure. We've got a couple of minutes, so why not?
Okay, so we already talked about looking at the overall in-sample, out-of-sample. You can do that with the randomization as well. Well, you can also apply the concept of stochastic modeling, or SPR, as a subset to optimizing your position size. So, a lot of the approaches that are used today use a Monte Carlo approach, which we talked about before, where effectively trades are reshuffled. Well, you can use a stochastic optimization that gets around some of those limitations we talked about, and effectively, what happens is the probabilities are much less optimistic, from what I've seen on applying stochastic optimization versus a Monte Carlo approach. So what does that mean? Well, it can help you from not achieving your worst case drawdown, or worse, blowing up your account. It's more conservative in general. Another thing which I believe is only possible with stochastic modeling, I haven't seen any other method, although I'm happy to hear of if there is one, is determining the value of an individual rule in your trading system. I'm sure that many experienced system developers can attest to the fact, I can as well, that the performance that you see is so much determined by the interaction of all the various rules that you have in your system. And if you test, say, a single rule up front, it may not be, and probably is not, very indicative of what you can expect when you apply, when you apply all the exit rules you may have, your position sizing, etc. You may have very different performance than what you're expecting from just looking at that one individual rule. But nonetheless, you may be very interested in what's the value of the individual rule. So if you have, say, just for the sake of argument, 10 rules in your trading system, various entries and exits, and position sizing, etc. Well, I personally would like to know are any of the rules actually not adding value overall to my performance? And that can actually be tested with stochastic modeling through effectively replacing the rule with what you can think of as a monkey throwing darts at a dartboard to pick values. and what you want to see is the across a broad distribution, the actual rule outperforms the unintelligent monkey, so to speak. So that's that kind of thing you can do with stochastic modeling as well, which is very interesting to me.
Yeah, is that stochastic modeling part of your MTA slides, or is that?
That is the topic of my MTA slides.
Ah, okay. Sorry, I missed that. That sounds great. We definitely need to get those slides in, I think, because that sounds like a really important area of research. So I'm sure that'll have a lot of value to other traders.
Sure.
So if you've got a couple of minutes now, I'd just like to speak to you about Status Trade, and your company Status Trade provides a service of performing independent analysis of trading strategies. So you see a lot of strategies come through the doors. What are some of the common flaws that you see in trading system development, other than the ones we've already, discussed today?
I think a big one that we haven't discussed is the choice of instruments or symbols. I see a lot of systems that come through the door that have, one of the first questions I always ask is, what are you trying to achieve with this system? And what's your logic for choosing what you've chosen? And I find in a lot of cases that people don't really recognize that they're effectively inducing selection bias into their system by their choice of instrument. So they may test the system on various combinations of symbols if it's a multi-symbol approach, or if it's a single symbol, they'll test it on a bunch of different symbols and then pick the one, choose the ones that they like that performed well. And a lot of people don't see that in the same light as overfitting or data mining bias from optimization. So that's one. I see a lot of the problems that we've already discussed come through the door as well.
Okay. Now, we did, at the start of the interview, we discussed some of the factors that can lead to data mining bias, but what about the type of tests that system developers and traders can implement in their own process? Is there anything additional to what we've talked about today?
Yeah, so it depends on how sophisticated the person happens to be, or how technically savvy. There are some academic approaches that work well for some applications as well. They tend to be somewhat difficult, but if someone has the technical prowess and wants to do that, they certainly can. So going back to the book I mentioned earlier, David Arnson talks about a couple in his book. His partner, Timothy Masters, is a PhD statistician. They've actually developed some software as well. But the two approaches he talks about are Monte Carlo permutation, which is different than the Monte Carlo approaches we've talked about so far. Yep. People can read about it if they haven't read that. And then White's reality check as well as another method that is out there, which is detailed in the book as well. In fact, he does a pretty good job of explaining how they work in the book. There's papers that come out all the time on this topic as well. People can probably search on SSRN and find, if they search for data mining bias, find newer approaches as well that they can implement.
Yeah. Okay, thanks a lot, Dave. Now I might just start wrapping up with a few quick closing questions.
Okay.
What's the biggest lesson you've learned through trading?
The biggest lesson I've learned through trading is also something that my statistics professor hammered in my head, and that has to do with type 1 and type 2 errors, and understanding what they are. So from a statistical perspective, of course, what we want to avoid in trading is allocating capital somewhere where we made a mistake and we were too optimistic on what to expect. So that's we want to avoid that. That's the lesson I've learned, because the converse of that is we don't allocate capital to actually a good trading system. You have to look at what's the cost benefit. So in the first case, you allocate capital to a trading system that you think is good and is not. It causes a loss of capital. In the latter case, it's simply a opportunity cost, not actual capital that's lost. So that's probably the biggest lessons I've learned, is to err more on the side of that.
Okay. And so what do you think is the most important ingredient to becoming a successful trader?
Well, I'd be remiss if I didn't say psychology, given that I've completed Van Clarp's Super Trader program, and I actually do believe that. You can be a super quant and develop all these tests and think you have something, and then if it's you that's trading it, even if you've automated it, you're still watching it. I assume you're still watching what it's doing. To be able to psychologically stand by that system, have the confidence to trade it, is critically important. None of this matters at all if your system gets into a big drawdown. You break your rules, you get out because you can't handle it psychologically, and the next thing you know, it turns around. Or the reverse is you don't get out when you should, and watch your account implode. So psychology still is a big component of this. No matter what we do, we can automate it all we want.
Okay. All right. Thanks, Dave. Now, you've already mentioned Perry Kaufman's book. Do you have any other favorites you'd like to recommend?
It depends on I have favorites based on the type of trading that people like to do. So trend following, I'm a fan of Andres Cleno, who runs a hedge fund out of Switzerland, and Catherine Comiskey has actually written a kind of a definitive book on trend following with futures, which I think is great. It's got an academic bent, but a lot of useful information there. Probably a lot of people are familiar with Larry Connor's work on mean reversion. That's another one. I would say though that I do like to read books, but I also like to read blogs. When I find a good blog, I'll spend some time on there. So
okay, well,
there's a lot of.
I was going to say, what blogs do you like to spend time on?
So I recently found out about yours. So you have some very good interviews out there. A lot of interesting topics that people bring up. So I think if people went through your list of people that you've interviewed and went to go look at their blogs, that's going to cover pretty much 90% of what I'm going to be looking at.
Yeah, we've been very lucky to have the guests that we've had. So it's been amazing.
Yep.
Okay, well, thanks a lot, Dave. So what's the best way for listeners to get in touch with you?
I'd be happy to take emails. If people want to email me, they can go to our website, statustrade.com, and find me. So I always appreciate having interactive discussions with people, so that's no problem at all. And that's probably the best way to contact me, is email.
Okay, thanks, Dave. And one final question. Is there anything else that you'd like to mention before we finish up?
I don't think so. I've really enjoyed this interview, and you asked some very good questions. So thanks for having me again.
Oh, thanks a lot, Dave. Well, we really appreciate your time today. And as you said, it's a great chat, and you shared a lot of information with us on your paper, and also some of the new stuff that you're looking into, which sounds very interesting. So if you're willing to share those slides, I'm happy to put them up on the show notes page so that people can find them easily. And just want to thank you again for your time today, and it was a pleasure.
Thank you. Ditto.
All the best.
Same to you, Andrew.
Okay, so a big thanks to Dave for coming on the show to discuss strategy evaluation and his approaches. Now, I'd just like to finalise a few things that were mentioned in this episode. Towards the end of our chat, Dave mentioned stochastic modelling and a presentation that he'd provided for the MTA recently. Well, that presentation is now available for you to view, so if you head over to the show notes page at bettersystemtrader.com/51, I have a link to the video there. Also, Dave has been kind enough to provide us with an article that is essentially an SPP addendum discussing some of the assumptions and limitations of SPP that we covered today, and it also explains the system parameter randomization approach a little further. So if you want to see more about that, you can find that by also heading to the show notes page, bettersystemtrader.com/51. Anyway, that's it for this episode. I really hope you enjoyed what Dave had to share with us today, and I'll catch you at the next one. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.